Hello again, Robert Schein here, Managing Director and Partner of Blanke Schein Wealth Management. Today is Wednesday, May 20th, 2020. To all of our clients, friends, and family out there, we truly appreciate all the support over the last 60, 70 plus days that we've been providing daily updates, daily broadcasts. Our mission here at Blanke Schein Wealth Management is to stay connected more now than ever with our clients. One of the positive attributes of our industry is we have clients all over the United States, from Alaska to Maine, Florida to Hawaii. And so I get a picture preview as I make my outbound calls to clients just to check in, provide updates, to see sort of around the United States. Today the US, all 50 states have reopened in some form or fashion. And as I have a call this morning with Maine, yesterday afternoon with heart of Manhattan, if you will, with a client who lives just outside of there in Queens, New York, and Florida. I talked to Colorado, Chicago, especially on the East Coast, especially Northeast, if you will. The weather's changing for a positive. So there's, in addition to having the ability sort of this weight lifted and going back safely and hopefully properly in the best way possible out there in the public, coming out of our homes and reemerging into sort of life itself. We're also seeing seasonal change with the weather, and that's providing sort of upbeat just from human nature. So the conversations are positive. The weather is changing, where there be spring to summer. I don't even know if they get that back east sometimes. Obviously we're in Southern California, and we've spent some time outside too, obviously spending as much time outside as possible in this new reality. But I will tell you, the one thing I want to share with everyone in a collective positive tone is that we're definitely a lot closer to getting out to what this is going to look like and getting out of our houses. We're on the other side of the curve. We've had all of these analogies, and the main analogy is the curve itself from the COVID-19. That's a virus that has claimed a lot of people, and it's tragic. But one thing we do know about viruses through the history of time, the only predicted model that has been out there that seems to be holding up, because a lot of models have been they're just very two extremes out there and everything in between, which is unfortunate. I wish we just had an answer, but we don't. But one thing is certain is that there's a bell-shaped curve to this, like all others. Now, we don't know if it'll resurge. We don't know. It's hard to imagine it could get bigger and worse than it was the first time, simply because now we know what we know. We didn't know what we didn't know beforehand. And now everyone's using the proper equipment and treatment and space, social distancing, and being a lot more thoughtful, careful, and obviously, just going about it the proper way on a go-forward basis. So I think that's what the markets see. Markets are sort of predictive of human behavior. And as states reopen, markets are saying, there's a hint, more than just a hint, actually a lot of pent-up demand in economic behavior. So let's get into our topics today. Our first topic is acceleration of trends. When you hit a recession, there are companies out there that will get stronger. Think technology companies, keeping us connected now more than ever. And then there are companies that are teetering on bankruptcy, even in a good economy. Specifically in the world of retail. Retail has been hit hard for the last decade, even more so, if you will. Big box retailers have had difficult times attracting traffic and keeping a square foot, a footprint in a mall, 10,000 square feet, up and running and paying the rent. Well, think about this. In times like these, it just accelerates that trend or pulls forward what ultimately is inevitable. Meaning over time, that new trends will take hold. This accelerated this pandemic downturn. Simply by that, think about this. 1% in growth in online e-commerce or retail sales. So if we get 1% in growth equals in the marketplace, 10,000 retail shops closing. Could be mom and pop shops. It could be big box retailers. We've seen several of them actually go out of business even in the last 60 days, file for bankruptcy. That's some of those companies have been around for over 100 plus years, and you know who I'm talking about. They had our catalogs that they would send out. Not anymore, unfortunately. But their business model in a time like this gets exposed, and ultimately the trends that are positive and that carry us forward for the next 100 years accelerate. In times like these, those that are dying business models, this is the last stop, unfortunately. So that's what we're seeing, and that's what I mean by acceleration in trends. So it's just interesting to see. Unfortunately, it's not good to see anybody go out of business or file for Chapter 11 bankruptcy. But there's a lot of retail shops out there that were eventually not going to survive, even 2, 3, 5 years from now. This just pulled forward all of that. And every time we have a growth in e-commerce, which we've seen a huge, tremendous surge over the last, 90 days, as we've all been in our houses, plus or minus, depending upon where you live, we've seen that acceleration of that trend. So here's one. Let me take you back 30 years plus, if you will. Today, we had, since the first time, since back to 1986, believe it or not, and I call that the Back to the Future. Marty McFly and Doc Brown brought to us Back to the Future back in 1985, but U.S. Treasury stopped issuing 20-year treasuries in 1986. Today, the U.S. Treasury brought that back, so I call it Back to the Future on the 20-year Treasury. Here are interest rate yields that we see. Your 6-month yield, so your bank deposits, if you will, or even in U.S. Treasury, I put it as nothing, so they're not paying you anything. So money that's piling up, and that's by design. The Federal Reserve dropped interest rates to ultimately zero because they want to force, monies out of the banks that aren't paying us anything. Ultimately, actually, the Federal Reserve did release the minutes thing. They would be open to negative interest rates, which means all of our bank deposits, think about this, all of our bank deposits, we would have to pay the bank to have them hold our money on a go-forward basis. They left the door open as the Federal Reserve might do that. That's why we've seen a huge influx here at Blanke, Schein Wealth Management from clients transferring in a lot of dollars from their banks, because banks aren't paying us anything to keep money there right now. And who knows, God forbid they go zero on the interest rate policy going forward. The 10-year Treasury, 70 basis points, so less than 1% on a 10-year Treasury for 10 years on your money, 1%. It's crazy. And the 20-year right now, there's a lot of positive news on this, simply because it priced at 121, so 1.21% for 20 years on a U.S. Treasury. That's less than 2% to hold your money for 20 years. Now, if you're like me, yes, there's going to be inflation, tons of inflation, simply because of all the liquidity that we're going to see. So, you have to be sovereign money that purchases, these investments. But other than that, I don't know that would be a good bet right there, to be saying, to be honest with you. But at the same time, the bid to cover is 2.5%. So for every $1 issued, there was $2.53, so $2.53 chasing that $1 issued by the U.S. Treasury. There's a lot of reasons and factors as it relates to that, and I'll talk about that in another daily update, because I think I'm going a little bit too long today, so I appreciate your patience in watching. But ultimately, it's good to see we issue a longer dated paper than just the 10-year. We have the 30-year as well. And we're going to have to finance our way out of this. So this is going to be a story that's going to evolve for years to come. But at least we got the 20-year auction off today. Our last topic is high-frequency data. I want to credit our friends Brian Westbury, chief economist, and our friends at First Trust with providing us with such great, timely, daily updated information for us here at Blanke Schein Wealth Management. And one thing that Brian's known for, and now the industry is giving him tremendous credit for, is high-frequency data. As they should, because Wall Street Journal now and all of the few other business programs in CNBC are now tracking this. Even big-time chief economists at other competing firms are now tracking high-frequency data. Now, it's nothing new. In fact, Peter Lynch, speaking of Back to the Future, used to do this 30 plus years ago when he managed Fidelity Magellan. He would go to the malls with his daughters and watch what stores his daughters would go in and spend money. He would then take that back and work its way into the investment portfolio. True story, and he made a lot of money doing that. He's just following behavior patterns, human behavior, and ultimately making common sense adjustments based upon strong balance sheets and strong management teams and trends that actually will last and play out over weeks and decades. And so he was very successful in doing that. And so the high frequency data in our industry is real-time information week over week. And it shows people going back to restaurants, people going back to movie theaters. TSA is picking up. There's people actually flying again. Obviously never to the amount of which we had even 90 days ago, if you will. But it's important information as it relates to our industry, because it's one thing to open up the store and say, okay, we're open for business. It's another thing to actually have somebody leave their house and actually shop on that good or service or retail place. And that's going to be critical, because there's a lot of businesses that are on the verge right now. They can't hold out any longer. In fact, Italy just announced that they've rescinded their stay on bars and restaurants. One of the hardest hit countries in the world basically said economically it would be too devastating to continue in this pattern, and they now are opening 2 weeks prior to what they originally stated. They just announced that last night. So you've got these forces of the economy now driving sort of the next few steps. And ultimately, we're going to find how this plays out. Hopefully it's in a thoughtful, smart manner. But I think it really could be done. It's even bringing back the drive-up. Drive-in theaters are there. And now you're going to see this. There's going to be changes in the law where obviously you can take food out to go, and obviously the ABC liquor laws have changed so that you could take a margarita to go with you. But now they're going to think outside the box. Actually, Italy did this most recently and expanded their patios. So you're going to see restaurants say, well, if I can't have everyone inside, I'll have everyone outside, and let's have blankets outside, as long as I can serve them and everyone can distance properly. So what we're going to find is a lot of innovations as a result of this. My final thought is, a friend of mine owns a car dealership in the Midwest, and he basically had his May last year. We were comparing their year-over-year sales, May to May. First 15 days of May, this year he sold 61 cars. Last May, the entire May, he sold 60 cars. So it shows that there's not only reopening, but there's pent-up demand. I mean, he sold more cars in 15 days under this environment than he did all of May last year, and we were in all-time record highs in the economy. So those are all positive green shoots. High frequency data is real-time information. You and I may not be leaving our houses, and if we do, it's in the proper way, but it's showing that the America itself is getting back. And we shall see and monitor this as in the weeks and days to come, and hopefully it's done in a proper manner. So thanks for listening today. Have a great night, and see you tomorrow.